In this business of markets, a man has to choose his battleground long before he fires his first shot. And today, we're talking about day trading, swing trading, and investing. 3 different battlegrounds, 3 different tempos, and how to know which one fits your temperament. And if you've been following along, you'll see how this naturally connects to what we discussed in the previous video on the 3 rules that made me consistent, because those rules matter no matter which path you choose. Now, listen closely. I've spent a lifetime watching the tape, studying the swings, and feeling the pulse of the market. The market has moods just like people, and your job is to find a rhythm you can dance to without stepping on your own feet. Tell me, have you ever tried trading in a way that didn't match your natural patience? If so, you already know the pain that follows. Day trading is the quickest pulse of the whole game. You're in, you're out, and you're relying on the immediate action of the tape. Not the promise of tomorrow, but the movement of the next few minutes. The day trader survives by speed and precision, no hesitation, no dreaming, just execution. And I'll tell you, the tape gives hints, but it never shouts. Can you really watch the market tick by tick without letting excitement or fear cloud your judgment? Most can't. That's why day trading demands the sharpest emotional discipline. You have to cut losses while the market is still whispering, not after it starts shouting. The public always waits for the shout, and by then, it's too late. As a day trader, your profit comes not from catching the big trend, but from catching a piece of the daily noise. And sometimes that noise is nothing but a trap for the impatient. Ever notice how the best-looking morning breakout often turns into the afternoon's biggest disappointment? Swing trading is a slower dance. You're holding positions for days or even weeks, waiting for the market to show its hand more clearly. That's a different mindset. You're letting the natural swings of price do the heavy lifting, and you're giving trends enough room to breathe. Unlike the day trader, you don't need to stare at every tick. You look for patterns, for setups that speak to you in a calm, steady tone. You ask the market, "Where are you really going?" And then you let it answer in its own time. This is where a trader begins to appreciate patience. Swing trading teaches you not only how to read the chart, but how to wait for the chart to complete its sentence. And waiting, mind you, is the hardest part of speculation. Most people destroy good trades not because the market turned against them, but because time wore out their nerve. Have you ever bailed out of a perfectly good setup just because it didn't move fast enough? And then there's investing, the slowest, most deliberate of the 3. This is where you're not looking for the daily flutter or even the weekly move. You're studying the business behind the stock. You're sizing up value, leadership, long-term cycles, and broader forces like credit, industry strength, and the character of capital itself. Investing isn't about clever entries. It's about choosing sound opportunities and letting compounding do the work. But let me tell you something, even investors need timing. The public loves to say, "Just buy and hold." But they usually buy at the wrong time and hold until the pain becomes unbearable. A real investor knows the difference between a market dip and a market turning point. Do you have the stomach to hold through uncertainty without losing your head? Now, the real question isn't which style is best overall, it's which style is best for you. A man must trade in a way that fits his nerves, his time, and his temperament. I've seen naturally impatient men try to become long-term investors. They always end up sabotaging themselves. And I've seen slow, detail-oriented thinkers try to become day traders. They freeze right when they should act. This whole principle ties right back to those 3 rules that made me consistent in the earlier video. If you remember, one of the core ideas was learning to act only when the odds favor you, and that applies differently depending on whether you're trading for minutes, for weeks, or for years. Your style determines how you recognize favorable odds, how long you hold them, and how you protect your stake when the market proves you wrong. Another thing, your system of trading must grow out of observation, not hope. The market rewards the man who learns from its behavior, not the one who tries to impose his wishes on it. Day trading teaches quick recognition. Swing trading teaches pattern memory. Investing teaches patience and conviction. Each one shapes your mind in a different way, and each one molds your sense of risk. So ask yourself, which lesson do you actually need most? Consider the mental strain too. Day trading demands a constant readiness to act, like a boxer's stance, always alert. Swing trading takes the discipline of planning, of setting levels and trusting your analysis. Investing requires a calm heart, capable of holding through storms without flinching. Which of these pressures can you handle day after day? And let's not forget, the market doesn't care which path you pick. It only cares whether you can survive your own weaknesses long enough to capitalize on its movements. That's why choosing the wrong style is one of the fastest ways to drain a trading account. If your nerves aren't built for the speed of day trading, you'll cut winners too fast. If you're too restless for swing trading, you'll enter too early and exit too late. If you're too emotional for investing, you'll buy high, sell low, and blame the market for your own impatience. The tape is always honest. It tells you when you've chosen the wrong battlefield long before your account balance does. Have you ever felt constant stress in your trades? That's not the market. That's misalignment. And misalignment is expensive. Every trader must reach a point where he stops asking, which style makes the most money? And starts asking, which style lets me trade without fighting myself? Because the real profits, the reliable ones, come from operating in harmony with your own nature. The market is tough enough. Don't make it harder by pretending to be someone you're not. Day trading demands rapid decision, making an emotional sharpness, and anyone who tells you otherwise hasn't spent enough time sitting in front of a live market when it's moving fast. When you're day trading, you're not dealing with the grand sweeps of economic cycles or the slow burn of quarterly earnings. You're dealing with the immediate pulse of price itself, the raw heartbeat of the market as it ticks, jumps, hesitates, fakes out, and surges. In that tight window of time, hesitation is as costly as ignorance, and emotional control is as valuable as capital. The market gives you seconds, sometimes fractions of seconds, to read its tone and decide whether the move you're seeing is real or simply bait for the impatient. And you have to ask yourself, do you trust your own judgment when the chart starts moving faster than your thoughts? Rapid decision making isn't about rushing. It's about recognizing what matters and discarding what doesn't with near instant clarity. A day trader does not have the luxury of pondering. When a setup appears, a clean breakout, a sudden shift in momentum, a violation of support, you must already know what you're going to do. That means your preparation has been done long before the bell rings. Day trading rewards the trader who walks in with a plan and punishes the one who tries to invent one on the fly. Every minute you spend uncertain is a minute the market uses against you. And yet most new traders freeze when the time comes to act. They stare at the chart, they question themselves, they hesitate, and in those extra seconds the opportunity slips away or flips violently. Have you ever watched a perfect setup unravel while you debated whether to press the buy button? Emotional sharpness is the second requirement, and it's not optional. Day trading creates rapid emotional spikes because the feedback is immediate. You're wrong quickly, right quickly, shaken quickly, tempted quickly. There's no long-term trend to comfort you, no broad narrative to lean on, no cushion of time to smooth out impulsive decisions. It's just you and the tape. And the tape is merciless to anyone who reacts emotionally instead of analytically. If you can't keep your heart steady when a trade moves against you by a few ticks, or when it surges in your favor and tests your greed, then the market will expose that weakness instantly. Day trading teaches you that the enemy is rarely the chart. It's your own impulses. How many times have you exited too soon because fear spoke louder than logic? When you're trading intraday, speed without control is just recklessness. You must train your mind to shift quickly between reading the setup, confirming the risk, and executing with precision. This type of mental sharpness comes from repetition, not excitement. And that's where most people misunderstand day trading. They think it's fast money, fast action, fast success. In reality, it's fast decision-making built on slow, steady practice. Behind every quick trade is hours of studying patterns, reviewing losses, refining entries, and building the ability to act calmly under pressure. Without that foundation, fast decisions become emotional decisions, and emotional decisions become expensive lessons. Another thing that separates successful day traders from struggling ones is the ability to avoid unnecessary noise. Markets produce endless flickers and false signals. Every small wiggle on the chart looks like the beginning of a move if you're anxious or eager. But a sharp mind knows how to filter those movements. You learn to recognize the difference between a genuine shift in momentum and a random fluctuation. You become sensitive to the rhythm of the market, the way liquidity flows at different times of day, the way certain levels attract aggressive orders, and the way price reacts to key areas. When your mind is sharp, you see these things naturally. When it isn't, every movement looks important, and you end up chasing shadows. Have you ever felt exhausted after a trading session, not because you traded much, but because you reacted to everything? There's also the matter of controlling impulse trades. Day traders face temptation constantly. A small breakout will lure you in early, a sudden drop will provoke a panic sell. A news candle will make you think you're missing out on the move of the day. Emotional sharpness is what allows you to override these impulses and stick to your plan. You must maintain mental discipline in an environment designed to trigger impulsive behavior. Every flashing candle, every sudden spike, every fast drop, they're all invitations to act without thinking. But a sharp trader recognizes that excitement is not a signal, fear is not a signal, and impatience is not a signal. Only the chart is. Rapid decision-making also means knowing when to do nothing. This is something almost nobody tells beginners. Day trading creates the illusion that constant action equals progress. But the best day traders often sit still for long stretches, waiting for the market to show its hand. They wait for clean structure, clear direction, and actionable setups. They don't take trades out of boredom or restlessness. It takes a sharp mind to stay patient when the market is dull and to strike decisively when the moment finally appears. In the span of a day, you'll shift from patience to aggression and back to patience again, and that rhythm requires emotional balance. Can you sit through an entire slow morning without forcing a trade just to feel active? And of course, rapid decisions must always be built on predefined risk. Day traders survive by cutting losses quickly and mechanically, not emotionally. A day trader without strict risk rules is like a driver who speeds but refuses to use brakes. Knowing your stop level before you enter isn't just good practice. It's necessary. It protects you from unexpected volatility and protects you from yourself. Without emotional sharpness, you start moving stops, ignoring rules, hoping the market turns. And once hope replaces discipline, the game is already lost. Day trading exposes those weaknesses brutally because the losses come fast and the consequences are immediate. All of this creates a certain kind of personality. Day trading shapes your mind into a tool, quick, decisive, disciplined, and emotionally neutral. It forces you to confront your impulses, your biases, and your reactions. It rewards the trader who stays sharp and punishes the one who lets emotions creep in. It is a demanding arena where your greatest advantage is not your screen setup or your indicators, but the speed and clarity of your own mind, the calmness of your nerve when price moves violently, and the discipline to act only when your plan aligns with what the tape is showing you. Swing trading relies on patience and letting multi-day trends unfold, and that alone separates it from the faster, more frantic styles of trading. When you're holding positions for several days or even weeks, you're giving the market room to breathe, room to fluctuate, room to test your resolve. Unlike day trading, where decisions must be fast and reactions immediate, swing trading requires a slower, steadier mindset. You're not trying to predict every intraday wiggle. You're looking for structure, the broader move inside which the smaller movements take place. And the real question becomes, can you sit through the ordinary noise of the market without letting your nerves dictate your next step? Patience in swing trading isn't the passive kind people imagine. It's an active form of waiting. watching the chart develop, observing how price respects levels, noticing how momentum builds or fades across sessions. A swing trader must learn to see the market in chapters instead of sentences. One day doesn't tell the whole story. Sometimes even 2 or 3 days don't reveal much. The move you're waiting for might take time, and during that time price will tempt you, shake you, test you, and threaten to convince you that your plan is wrong. That's where real patience comes in, not the kind that hopes blindly, but the kind that waits with intention, backed by preparation and logic. Have you ever watched a good trade almost push you out just because it hesitated longer than you expected? Swing trading is a game of levels and patterns, not impulses. You're looking for higher lows forming a trend, or lower highs showing a weakening structure. You're watching for breakouts that have real conviction behind them, not just quick sparks of excitement. You're studying the behavior of the market over multiple days to understand where the path of least resistance might lie. And unlike day traders, who often rely on immediate price action, swing traders rely heavily on context, the story that the chart has been telling for days or weeks. That wider view is what gives swing trades their potential, but it also requires the trader to tolerate more uncertainty and more time. The question is, can you trust your analysis even when price retraces, pauses, or tests your entry? Another crucial part of swing trading is accepting that price moves in waves. It does not travel in straight lines. Even the strongest trends will pull back, consolidate, or retest levels. New traders often misinterpret these normal fluctuations as reversals, leading them to exit too early or doubt their positions. A skilled swing trader understands that pullbacks are part of the journey. You're holding through the ebb and flow, not reacting to every small shift. But holding through those shifts requires emotional stability, because every red candle and every pause will stir something inside you. Impatience, fear, doubt, and if you can't manage those emotions, the market will push you out long before the trade completes its natural move. Have you ever exited a trade only to watch it run exactly where you expected? There's also the matter of choosing the right trades. Swing trading isn't about taking many trades, it's about taking the right ones. Quality is more important than quantity. Since you're holding longer and exposing your capital through more sessions, you must be selective. You're looking for setups where the trend structure is clean, the momentum is building, and the risk-reward ratio is worth the time you're committing. Unlike day traders who can recover quickly from small losses through frequent opportunities, swing traders often have fewer chances, which means every entry counts. That's why analysis matters. Technical levels, volume clues, trend alignment across time frames, and even broader market sentiment. You're building a case before acting, and once you act, you need the patience to let the case play out. Another part of the swing trading mindset is understanding overnight risk. You're holding positions when the market is closed, when news can break, and when price can gap unexpectedly. This forces you to think differently about risk management. You're not just protecting yourself from intraday volatility, you're preparing for surprises that can occur between sessions. Your position size, your stop placement, and your expectations must account for that. It teaches you respect for the market, for uncertainty, and for the fact that not everything is within your control. Managing this risk requires a calm, steady temperament and a willingness to accept that the market may open in a different world than the one it closed in. Can you sleep comfortably while holding a trade that's still unfinished? The patience required for swing trading also shows up in your entries. A lot of traders enter too early because they want to catch the whole move, not just the reliable part. But early entries come with more noise, more uncertainty, more shakeouts. The disciplined swing trader waits for confirmation. A breakout with volume, a retest that holds, a trend line that proves itself, or momentum that shifts clearly. It takes patience to wait for the right moment instead of acting on anticipation. It takes even more patience to watch the market move without you and still not chase it. Swing traders quickly learn that missed trades are cheaper than bad trades. Holding a trade is another challenge. Once you're in, You must resist the urge to micromanage every candle. You need to trust that the trend will unfold if your analysis was correct. Watching price all day can make you exit prematurely, so swing traders learn to check charts less frequently and with more intention. You're looking for structural changes, not emotional ones, and this teaches you discipline. Because swing trading rewards the trader who protects their mental energy, not the one who obsesses over every tick. What makes swing trading powerful is that it blends patience with active decision-making. You're not as rushed as a day trader, but you're not as detached as a long-term investor. You're constantly evaluating, adjusting, and waiting for the market to reveal the next piece of the puzzle. It's a style that builds emotional resilience, because it forces you to accept fluctuations without reacting impulsively, and at the same time it strengthens your analytical skills, because every trade requires a broader understanding of the market structure. Investing focuses on long-term value, compounding, and business fundamentals, and that puts it in a completely different category from the faster styles of trading. When you invest, you're not trying to capture the daily swings or even the moves that play out over a couple of weeks. You're looking beyond the noise, beyond the immediate volatility, and into the underlying strength of the company or asset you're putting your money into. You're committing capital with the expectation that time itself will work in your favor. But the question you have to ask yourself is this: do you have the patience and conviction required to let time do the heavy lifting? Long-term value isn't about guessing where price will be tomorrow. It's about identifying businesses that produce real earnings, generate real cash flow, and have the potential to grow over years. You're evaluating leadership, competitive advantages, market position, and the financial health of the company. Unlike trading, where charts rule the decision-making process, investing asks you to look deeper, into balance sheets, income statements, and long-term industry trends. You're not concerned with a temporary dip if the underlying business remains strong. In fact, many of the best investors welcome dips because a temporary decline in price has no impact on long-term value. But the real challenge is whether you can stay calm when the market pulls back and everyone around you is panicking. Have you ever held a strong company and still felt uncertain just because the market went red? Compounding is where the magic of investing truly shows itself, but compounding requires time, real time. Years, not weeks. The growth isn't just from the stock price rising. It's from reinvested earnings, dividends, and the expansion of the business itself. Every year the company grows, your investment grows with it, and that growth compounds on itself. But compounding only works for those who stay invested long enough to see its effects. Most people never get that far. They get nervous, they get impatient, or they get distracted by the next big opportunity. They interrupt the compounding process before it reaches its true potential. Have you ever calculated how much more an investment would have been worth if you had simply left it alone? One of the biggest differences between investing and trading is how you respond to volatility. Traders often fear volatility because it can stop them out or ruin a setup. Investors see volatility differently, as something that happens along the way but doesn't necessarily change the long-term story. If you believe in the value of the company, temporary price fluctuations don't shake you. But believing in that long-term value isn't as easy as it sounds. It requires emotional strength, patience, and a willingness to stay rational when others are reacting emotionally. Investing forces you to think in terms of years, not days. That means you have to detach yourself from the short-term noise. The news cycle will always be loud. The market will always have pullbacks, corrections, even crashes. Your conviction has to be built on understanding, not on hope. If you don't truly understand the business you're invested in, the moment something unexpected happens, you'll be tempted to sell. That's why seasoned investors spend so much time studying fundamentals. They want to know what they own and why they own it. Another key part of investing is position sizing. When you're investing for the long term, you're often allocating larger amounts of capital because you're seeking meaningful growth over extended periods. That means choosing carefully. You can't spread yourself across too many positions or chase every opportunity. You must develop a framework for evaluating which companies deserve your long-term commitment. That kind of focus requires discipline, because the market will constantly tempt you with new, exciting, fast-moving names. But long-term wealth comes from owning strong companies for long periods, not from constantly jumping into the next trend. Investors also need to understand cycles, economic cycles, industry cycles, and even company-specific cycles. No business grows in a straight line. There will be periods of expansion, consolidation, slowdown, and recovery. The long-term investor learns to recognize whether a downturn is a temporary phase or a sign of deeper structural issues. That awareness separates those who panic sell from those who accumulate more. To do this well, you must think like a business owner, not just a stockholder. And that's where the mindset shift happens. When you think like an owner, short-term price dips look like natural business fluctuations, not threats. But how often do you actually think about the company behind the stock, rather than just the stock itself? Another essential element of long-term investing is resisting the urge to overreact to market sentiment. The crowd loves stories. Hype, fear, excitement, rumors. These things drive price temporarily, but rarely define long-term value. If your decisions are based on crowd behavior instead of business fundamentals, you'll always be late, buying at the top, selling at the bottom, chasing noise instead of accumulating assets. True investors separate the story from the substance. They look past headlines and focus on numbers, management performance, and long-term direction. Investing also requires accepting that progress is not always visible. A company might be reinvesting earnings, developing new products, expanding into new markets, none of which will immediately show up in the stock price. Investors must trust the process, not the moment. That patience is what allows the hidden value to eventually surface. Meanwhile, traders who expect instant movement will abandon the position long before the payoff appears. Over time, investing rewards discipline, understanding, and resilience. It punishes emotional decisions, impulsive reactions, and unrealistic expectations. It's a slow game, but when played correctly, it becomes one of the most reliable ways to build meaningful, lasting wealth. It asks for your patience, your conviction, and your willingness to stay focused on long-term value even when the market tries to distract you with short-term noise. Your trading style must fit your temperament, not your ambitions, and that simple truth is one of the biggest dividing lines between traders who survive and traders who burn out. Many people enter the markets with dreams of fast profits, glamorous setups, and bold strategies, but they rarely stop to ask themselves whether their own psychological wiring supports the approach they're trying to use. Trading isn't a matter of choosing the style that sounds impressive. It's a matter of choosing the style you can execute consistently without fighting your own nature. And that leads to the real question: have you ever forced yourself into a trading method that felt exciting, but never actually fit the way you think, react, or handle pressure? People love the idea of day trading because it sounds intense and full of adrenaline. They imagine themselves catching quick moves, pressing buttons, racking up gains in minutes. But the reality is that day trading demands laser, sharp focus, fast decision-making, and the ability to handle immediate emotional pressure without losing clarity. If your temperament leans toward caution, reflection, or slower, deliberate thinking, then forcing yourself into a high-speed environment will naturally create stress. You'll hesitate when you need to act, overthink when you should execute, and feel overwhelmed by constant price movement. And when your temperament and your trading style clash, the market will expose it quickly. How many times have you talked yourself out of trades simply because you weren't comfortable with the speed of the moment? On the other side, swing trading attracts people who like structure, patterns, and trends. It's a style that rewards patience. The kind of patience that lets you sit through small pullbacks and sideways days without panicking. But if you're someone who needs constant stimuli, who gets restless waiting for something to develop, swing trading can feel painfully slow. You may start meddling with your trades, pulling out early, jumping back in, or taking setups that aren't ready simply because the waiting becomes uncomfortable. That impatience doesn't come from the market, it comes from temperament. And when you ignore your nature, you end up sabotaging your own trades. Have you ever closed a perfectly good swing setup just because nothing happened for a day or two? Investing sounds appealing because it's often presented as simpler and safer. But real investing isn't just buying and forgetting. It requires conviction, long-term thinking, and the emotional stability to hold through drawdowns, corrections, and fearful news cycles. If your temperament is easily shaken by uncertainty, investing may feel harder than trading. The long stretches where nothing exciting happens, or the periods where price dips without clear recovery, can wear on you. Without a temperament suited for patience and long-term belief, you may end up selling the moment fear rises, even if nothing has changed in the fundamentals. And if you can't hold through temporary declines, true investing becomes nearly impossible. How comfortable are you holding something for months, even when the market tests your confidence? The biggest mistake traders make is choosing a style based on lifestyle fantasy rather than psychological reality.